All right, so in the past, I talked about how maybe this August would be a little different than prior summers, and usually those last couple weeks of August, very, very quiet, very low volume as we head into Labor Day, and then things pick up again. And I thought maybe this will be different because not everybody can travel and go different places, but it's seeming like that's not the case. That this is going to look very much like the normal August, quiet before the storm, so to speak. And how bad the storm is remains to be seen in September and or October. But a very quiet day today. I'm going to break down, again, the trends and how long we expected the trend like this and what it means and what our expectations are as always. And then today's trade idea is going to be a stock that's not being very quiet, that's had its own little breakout move. And there are some stocks that are doing their own thing. That are making some big moves, some related to Berkshire Hathaway's release, some not. So we're going to break down one of those that wasn't necessarily, and talk about how to trade it and how to trade it from a level where we don't expect a big move, and can we still make a directional trade from a stock where we don't expect big time move. So let's go ahead and get started. Today is Monday, August the 17th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another really small range day today. A little bit of an upward bias, of course, finishing 0.25% higher, but range 8 points was all. Now, granted, there was a little bit of a gap, so we closed 33.72, the low 33.79, so at about 7 points to that, and even then, that's below half. I mean, it's extremely light volume that we're getting here. The near-term line stayed in the upper half of the chart. The intermediate posture, of course, strongly bullish. Market sentiment had turned back up, but now it's turning back down because we're going this so slow. It's snail's pace here, which is impacting the long-term line. And, of course, the momentum line bounced back up from its intermediate confirmation signal that we got on Friday. You can see the Dow's near-term line fell into the lower half of the chart. So its near-term line run is done, even if the pullback has been a flat move instead of an actual drop. The Nasdaq had gotten a near-term decline before everybody else did. It's still holding up, and it's actually kind of pushing towards another possible cluster there, depending upon how we close. We got a new high that the S&P is jealous because the S&P's been trying to get a high point and it can't quite get one, and the Nasdaq just gets them whenever it wants, it seems like. And then finally, the Russell 2000, again, it's same as the Dow, had that nice little move here where those two outperformed. There was a lot of chatter about the great rotation trade, and again, all it did was kind of catch up to where, a little bit where the S&P is. The S&P sitting above its 78% line and working its way towards 100, whereas the others just barely getting through the 70% line. So strong bullish postures across the board, falling market sentiment lines pretty much across the board as well, even if the Nasdaq's still above 80. So it just kind of gives you an idea of how, it's just a mature trend. It's, when you got strong bullish posture and rising long-term market sentiment, it's great. But when you got falling market sentiment, it doesn't mean you have to go down. It means that it's easier to go, like you have, that's where the path of least resistance is. So that means you can have more down days than you can have up days. But that doesn't mean necessarily that the down days are bigger. It doesn't mean necessarily that that the up days are not very big. So you can still actually rise with a falling market sentiment line. Again, it limits opportunities, right? From a broad standpoint, and when everything's bullish and everything's rising because the market's rising, that helps all your bullish directional trades. Well, now it's, as we talked about before, that's not the case. So we have to kind of be picky and choosy, especially with the near-term line. I mean, it's just, especially on the S&P, it's been up this whole time. So you'd expect a pullback that we did get in the Dow, and that we already had gotten in the Russell, and even worse on the Nasdaq. The Nasdaq was the only one actually that got a near-term pullback with a decline. Didn't produce any light pink shading or anything. And keep that in mind. Like, we have dark green shading and green lines all across the board here. So that's about as bullish as you can be until you get a change in that regard, until you get light pink shading or you drop significantly enough below the 30-day moving average, then there's no expectations. In fact, like I said before in Friday's video, in Friday's technical analysis class, we went through the different stages of watching for a pullback. That can be applied in individual stocks too, mind you, like if you're trend trading as individual stock to the upside, to know when that trend may be, or at least when the intermediate run may be ending. What are some signs? And as of right now, we're just not getting any of those on the S&P. We're not going up very much either, but that doesn't matter, right? It's when markets doesn't run out of buyers. There's always plenty of buyers. It just runs out of volume because the buyers that you end up with at the end of a run are really, really small buyers. Very small volume, very weak hands, but there's plenty of them. So, you can grind higher until there's a catalyst to spark. And we'll see if, this week with retail earnings, provides any kind of catalyst. But as of right now, I think options expiration will probably be your biggest catalyst at the end of the week. Once we're done with options expiration, you might end up with that bout of volatility that you typically get in the month of August. And if you notice, we just haven't gotten in this month of August. We've been pretty much down below, here's August here. So we've been below 85% the whole month of August, and we've been below 80 for a good chunk of it, and we continue to be there. So it seems like we're going to just kind of continue to grind our way up here, barring a catalyst occurring earlier. But until this options expiration week is over, and then not that we'll tank. I don't even think we'll tank like that. But at that point, you start looking to see if post expiration provides, as we've seen multiple times. When you come out of expiration, there's a little bit of volatility. We'll see. Here's the one example where it didn't, and we just rallied. But there was some pretty down. There the market sentiment line was rising and crossing through the midpoint, so a strong bullish level. But all the other options expirations, there was some pretty significant selling coming out of it. You can see even over here in January, at the end of that long intermediate run. Remember, we're over 4 months now into this one. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, click that thumbs up icon. That tells us two things: you liked our video and you want us to do another one tomorrow. So, quick way to give us feedback. If you like our videos, let us know. Let us know with one click. You can do that right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What questions or comments do you have about anything I discussed in the video today? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between videos. You can see my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, we invite you to check out some of the other things here on our site. Over to the right, you can see our class schedule. Tomorrow morning, Brandon's very popular dividend growth investing class, one of the best classes we have here at Market Scholars. My directional option strategies class is tomorrow as well. Again, all of our subscribers, our monthly and our premium subscribers, get access to all of our trading rooms. So make sure you check that out. Also, they also get access to our Market Outlook live videos. So every day I do the Market Outlook, I also do a live trade review video. We go through and we look at all the old trade ideas we've done, and we continue to manage them until we close them. So that's beneficial for some who watch these. Again, a lot of people will tell you about getting into a trade here or getting into a trade there, but we continue to monitor and watch the trades from day to day, and we monitor them in this video here, as well as we typically put on today's trade idea before the market closes. Not the case today with Thinkorswim acting up, but we'll see if it ends up going through tomorrow morning or not. We also invite you to engage with us here on social media. Click that heart. It opens up this new window where you can hit this like button there. Also click on this thumbs up. That takes you to your Facebook page where you can click on that like button. Again, the more you do that, it benefits us because Twitter and Facebook will promote our content to all of our followers, even if they're not online when we post these. It also benefits you because they will promote content in your timelines when you're not online. When you log in from accounts that you've engaged with the most, so you don't miss anything. So we want you to engage. We try to make it very easy for you to engage with us here. All right, now let's get back to the charts and let's take a look at what's going on here. Here, let's do this. So it makes it a little easier to see. Make the screen bigger. All right, so let's take a look at the weekly candle now that we are 1 day in to this new week's candle. Very, very high. Look how high the PPO is. Now we've been kind of monitoring it on the way up, but now we're at 4.5 or 5.5%. That means the 50-day moving average or 10-week moving average is nearly 5.5% above the 200-day moving average. That's a pretty significant amount of momentum. Of course, that usually happens when you first come off a significant low like this. But you can kind of see, like recently, the February pre-COVID high was that bullish. The January 2018 high was that bullish. If I were to go about a little bit further to kind of give you some perspective on this, you can see in 2013 we were this high for most of the year. Granted, that was QE3, but we've kind of got QE4 going on right now, as well as 0% interest rates like we had back then too. And it's indefinite. We don't have, there's no end to their potential buying program. They can be able to buy treasuries if and whenever they need to and increase their balance sheet, even though that's kind of slowed down here lately. But you can kind of see too here, coming off of some significant lows, we got even higher, and there's another one coming off when we first started these golden crosses. We had some pretty significant levels here, even over here, coming off of that low point and the credit downgrade low, and then we got up to about this level and we pulled back down. Of course, when you look at the NASDAQ, you can see that we're higher. The NASDAQ's more bullish now. Its 50-day moving average is more bullish now than it's been in a very, very long time. Over 13%. That is just insane how high it is. And again, for some perspective, if I were to go back as far back as we can on the NASDAQ 100, which goes back to, looks like the 86, we were this high. See here. So we haven't been this high this whole bull market that we've had. We were this high back in the late 90s. We exceeded it in 99. Or got up to it about late 98, coming off of that 98 low, which I've compared this COVID low point to, and then we stayed up above it. And we got up to about 28% above. By the time all was said and done, we also did here too in 95 when we had that mid-cycle adjustment there with some rate cuts, and you can see that didn't stop the train from going back then, and also too coming off this low point in early 90s, 91. And so it's been this bullish before, but not in a long time. It's this is more bullish than we've seen on the index. It doesn't quite look like that, the log scale, but this kind of gives you an idea of just how strong the more positive momentum is. Very, very strong. Not necessarily the case though in, say, for example, the small cap, which has barely gotten its own golden cross just a couple weeks ago. And you can see so far a little bit of an inside candle. We'll see how this plays out by the time all is said and done. But we just barely got the golden cross, and the same thing on the Dow Jones. We're just into this golden cross, but good bullish candles so far across the board. Only slightly higher closes. We're not getting higher highs yet. But just kind of keep your eyes on that, and the S&P, especially the S&P too, is giving us a pretty decently bullish candle as well already with a higher close. We'll see by the end, right? That higher close takes into account the open, high, low, and close, the average of those four prices. So we kind of need to see how things play out. But we are a slightly higher high here. Just not quite high enough to get a new tag. 33.93 is that key number that obviously everybody is paying very, very close attention to. Let's take a look at the 8-day moving average, the 17-day moving average. And you can see how we're riding up the 8-day. So as quiet as it's been, we're still You know, the MACD is flirting with its moving average. Stochastics is below its moving average, but they're both very high, so it doesn't really matter yet in terms of a sign of weakness. So we're continuing to ride pretty well here to the upside, and again, no sign of weakness necessarily. You saw, you know, a little bit of, we broke the 8-day moving average and held the 17 on the NASDAQ, and then when you look at the Dow, you know, again, its weakness and the small caps has been limited to the 8-day moving average. So not a whole lot of weakness yet. Again, it might be options expiration by the time we get any kind of break below either the 8 or the 17. If we end up with a little bit more of a pullback, or even the beginnings of an intermediate pullback, if we were to break through. Because again, for us to break through, for us to break through the to get to the 23% retracement, we're going to be well below breaking the 17-day moving average, as well as the 30-day moving average to get down to that 23% line, which is now sitting right about 310. So, you know, the 17-day moving average is at 333. So that we're obviously going to see, unless we go from 337 to 310 in one day, we're going to see plenty of signs that the intermediate run is ended, and you know, not that we'll necessarily fall off a cliff here, because I don't expect that to be the case. The momentum is way too strong, but I do expect us to slow down a little bit, slow down, and well, we already have slowed down, so continue to slow down even more. I don't think we'll go down. I think we'll just kind of slow down even more than what we have right now, and grind our way down to at least 23, if not eventually 38 again. But that won't be anywhere close to. I mean, I don't think, obviously it won't happen by the end of the week. Most likely won't start happening until next week. And really, it might be until Labor Day. And again, the catalyst might be school starting here over the next couple of weeks to see, you know, how things go, and whether or not, you know, I know initially the initial catalyst for kind of an economics shutdown was the NBA closing down, but that didn't necessarily spark a sell-off quite yet. In fact, by the time we got the NBA shut down, we were already bearish in the equity market. So, but you know, if college football shuts down, you know, and all the economics that are involved with that, we already have half of it pretty much shut down. You know, if the other half shuts down as well, and universities shut down, and the economic that are involved with students, student towns, student cities, students being back in, you know, the apartments and mortgages and everything that's ancillary to what to a functioning school year on a university level all across the country. You know, that could very well end up being a catalyst, especially if it bleeds down into high schools as well, and kids have to stay home again. So, but obviously not by the end of the week. So until then, just expect more of the same. I mean, look at another gap to fill here from this morning. We still got this gap to fill from over here. You know, we don't always necessarily fill gaps, but gaps that we don't fill have pretty common characteristics. And these don't necessarily fit those. Very, very low volume, very, very common gaps. Got a lot of characteristics of common gaps. So, you know, again, we might pull back a little bit, you know, towards like 333, but even, you know, and fill in some of those gaps, and that's where the 17-day moving average would be. I wouldn't expect any more than that. In fact, the possibility of that occurring again by Friday is very, very low, considering the strong momentum. Now, that doesn't mean that we're going to spike up and go parabolic to the upside either, because there's very, very light volume. It's just a very slow grind. And, you know, consider right now the VIX is above 20 still, so it's relatively high. But also keep in mind that this is like having an 11 VIX. You know, when we're normal, when the markets are bullish and normal, because of how low it is on a relative basis down here at 80%. I mean, the VIX 3-month here is still at 27.5. So, like, long-term volatility is still pretty high. There's still, like, it's not falling. There's still some anticipation of things getting a little. We all know what it is, right? In the next 3 months, we'll have a presidential election or not. We'll have a result or not. And that's the uncertainty, and that's what the market is saying with the VIX 3-month, right? They're saying, okay, there's a lot of uncertainty out there, but just not within the next 30 days, according to the VIX, right? They know that we're in a grind and Labor Day and summer holidays, and we'll see how things shake out with the beginning of the school year. But that also means that you just move so slowly, like very small ranges, which is now close to that 1% mark. Very low volumes, which, again, this is like having an 11 VIX. This is a very, very similar pattern. Maybe not the ATR yet because it's still above 1%. But the volume is back at levels that's very similar to like having a very low VIX. In fact, the average is down to one of its lowest levels of the whole year here. So even though that we were here, like when we were here at these levels pre-COVID, the average volume was like in the low 60s, and of course now we are dropping into the low 50s on the volume, even with a 20 VIX. So it kind of shows the complacency in the near term, even if over the longer term there's still some heightened volatility risk. All right, so to summarize our technical outlook, the posture remains bullish. It's going to grind. There's going to be some individual stocks, as we saw today, that do really well. But for the most part, the broader market as a whole will just be a slow grind higher. It's just a matter of picking and finding those individual directional opportunities as they come. We've had a few in recent market outlook videos. Today we'll have another one. But we'll just kind of like look for individual trades, but we can't expect that those individual trades will be helped by the rising tide, right? The tide is about as high as it gets, and there might be a little lift from it, but the individual trades need to kind of be on their own, so to speak, in terms of their directionality. But other than that, again, I expect that to continue through the end of this week, depending upon how the rest of the summer goes before Labor Day holidays, but the longer term volatility indexes suggest there could be some higher volatility going into next month and into October, and of course everybody knows the reasons why. It's that as long as there's more and more uncertainty surrounding that, the markets don't like that. So expect, especially coming off a really overbought market, expect some of that overbought condition to be rectified. And then that's okay, though. That will set us up for a better low point to come off of that we can sustain coming out of November for a little bit longer than if we were to just grind our way through the next couple of months to the upside without it, right? Because then, again, the longer these runs last, the bigger the exhales are and the more uncomfortable they are. So we're trying, we would like to avoid that as much as possible. So what do you think? Do you agree with that technical assessment? Do you disagree? Let me know in the comment section down below, especially if you disagree. What are you seeing that suggests either to be more bullish than what you saw here, or to be a lot more bearish than what you saw here? And share what you're seeing, what charts or indicators you're watching down in our comment section. All right, now let's take a look at what's driving price action today. So let's take a look at the moves, and you can see the strength in equities over the past 3 months, especially small caps and internationals. SPY is actually the lagging, even lagging behind the EFA a little bit now. Let's take a look at just today, though, and how this week has started out here, this slow grind of a week, and you can see very, very weak move in the dollar and the effects that's had. Commodities, gold, emerging markets, all very, very strong. That, of course, is a tremendous, big tailwind. It's hard for equities to again really fall off a cliff with the dollar rising or dollar falling as much as it is. It continues to move its way to the upside. A very strong bullish posture for the euro relative to the dollar. That's the biggest the biggest component of the dollar index is the euro US dollar. So very, very strong move higher. The weekly chart looks very strong too, and it's got strong positive momentum, and that's that's going to keep equities from really kind of showing strong pullbacks as long as this continues to trend. And that's had an impact on commodities, as you saw. So commodity prices finally breaking through their 200-day moving average. In fact, if you look at the Bollinger Bands here, there's always that big gap for commodities to clear through, and it's starting to do that more and more. Here's what the 3-year looks like, and you can see how far it has to go before it gets back to kind of where it was. On the other hand, you can see gold just trending higher, and it's had a really negative week last week with that big decline, but of course big bounce back. A lot of that driven a little bit by what's happening with Berkshire Hathaway, the implications of what came out of that release on Friday afternoon. But we did gap back up and back into this gap and starting to fill that gap. But keep in mind too that we're still very strongly bullish, and bonds even came down to this significant volume node and had a really negative week too. Kind of a risk on week last week from that regard in terms of the safe haven. I told you that too, that's a significant tailwind for equities as well, to have the safety trade unwind. Gold doesn't have to unwind as much because it can still get a lift from weakness in the dollar. But between the dollar unwinding and volatility unwinding, it being still at relatively high levels, and bond prices unwinding, there's a really, really good opportunity for equities to get it. I mean, even with a bout of volatility coming up, there's opportunities for plenty of tailwinds for it to have some strength going into the end of the year and into next year as well. This is the weekly chart for the 10-year yield, which has been so beaten up, but last week, a very good week, getting above the 50-day moving average, a good bullish Hakunashi candle here. We've seen this before, though, so we don't want to get too crazy here, but at least that's a positive development after being so negative and coming off of this bullish divergence here. A reflection of rising inflation expectations would be a very positive sign for the economy right now, because the worst thing you can have is no inflation, right? And so obviously that's the biggest concern the Fed has. And so if yields are rising, that's a reflection of rising inflation expectations. Be a positive sign all across the board. And again, bear markets don't start with yields very low. Bear markets end with yields getting extremely low. And we've seen that, right? We've seen this bear market essentially that we've been in since the beginning of 18, but especially since the fall of 18. We've seen what yields have done since then. I mean, it's hard to imagine us being above, pretty much at 3.25% before this quote unquote bear market, stealth bear market started here. But we were at 3.25%, and now we're still at we're still under 75 basis points. So there's a lot of opportunity for inflation to rise before it gets too high. That typically starts recession. So that's why I say once we get through this bout of volatility in the next month or two, then there's significant tailwinds going into the end of the year and well into next year as well. All right, now let's look and see how the sectors, and of course we all know again the weak dollar move. Let's see, it's right here. Weak dollar move. We anticipate what the reaction will be from a sector rotation standpoint with that. Here, let me bring this up here, and you can see, interestingly enough, 2 of the 3 sectors that you would expect to do really well in a weak dollar environment did not participate. So industrials and energy stayed negative. Again, a little bit of a reflection too of coming out of the Berkshire Hathaway release. Financials, of course. I mean, all of that is a reflection. Materials held up too, again, because of the minor stocks. And then, but there's your technology, your discretionary. Amazon took really hold today of leadership. Communication services lagging a little. Utilities, real estate was up. Real estate was up here, along with consumer staples. And a lot of these retail companies anticipated to have a pretty significant week here with plenty of earnings announcements, and they all did. Consumer stocks did very, very well. So, not your typical anti-dollar trade from a sector rotation standpoint, but it also kind of shows how a news release can have an impact in very small moving markets, right? And that's what happened here today, and we'll see how this trend develops over the course of the rest of the week heading into. I wouldn't expect these to continue, especially if yields are rising. You would expect this to be a short-term blip for financials, as well as for in energy and industrials if the dollar continues to fall as well. But it does go to show that, again, the strength continues to be in these large cap tech names. It might be different areas in that tech space, but that continues to be the strength, and we'll continue to ride that strength as long as we can. But a little pocket of strength that occurred today that hasn't necessarily been the case over the last 3 months. When you look at a 3-month here, Staples has been a laggard because it's been, a safety trade, but it's picking up. You expect they'll start to pick up a little bit at the end of mature phases, and so that's where our trade idea is going to come from tonight. All right, so that brings us to Walmart. A nice little cup and handle formation and a little bit of a breakout today on Walmart up to new 52-week high, strong posture, rising market sentiment that's rising back up above 50. Positive development from that regard. Obviously, with 52-week highs, you have bullish charts. So we continue to show strong positive momentum here. You look at like its RSI indicator, well up above 60, breaking back up above 60, breaking above 200 on the CCI. Good, strong breakout in that pattern. You look at its DMI, you can see it does have strong ADX and a kind of some getting back above 30 on the positive directional index, back below 10 on the negative. So kind of a renewed move to the upside here. It's linear. It's not linear regression. It's trend strength indicators show that we are in a very strong trend. We're close to getting above 5. We're already above 80. Well above the cloud, well above its blue line. The red line's above. So you can see here, it's a very, very strong move, and you can see there's opportunity for the red line to move away a little bit from price here, because we were close to kind of crossing through there before this breakout occurred. So now that we do have this breakout, and obviously well above the 8-day moving average, and we got a little bit of a convergence. Now you would expect a divergence to come out of this. Obviously a bullish divergence with the MACD strong and stochastic strong, and the MACD crossing above its moving average. So we say, okay, well, let's take a look at the September options. We don't have to worry about earnings here, but we'll sell that 145 strike and buy the 140 option. So we're buying a little bit out of the money, but we're going to offset that cost with the 145. Now the stock's up in the after hours a little bit, so we'll kind of keep our eyes to see if we can actually get filled in on this tomorrow. As of right now, that gives me a 3-to-1 reward to risk ratio at the worst case scenario. Of course, if we nullify this breakdown, we'll lose a couple $100, and that ends up giving us about a 6-to-1 reward to risk ratio. But kind of a high probability setup here from a directional standpoint. Obviously, it's still low probability in general, but higher probability than other directional trades, because you can see the max gain is well inside of 1 standard deviation. So if this can continue to grind higher, then we can get a pretty decent opportunity out of this from that price pattern, that bullish price pattern that showed up on the chart today. All right, well, that does it for today. As always, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. Open up any new thread with any questions or comments you have about what we discussed in the video tonight. Reply to anybody else's thread as well, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Remember also to hit that heart, the like buttons on the Twitter and Facebook Market Outlook posts as well. Again, thank you for watching. Have a great rest of your Monday night, everybody, and we'll see you all next time.